Silver just ripped over 6% in a single trading session. After yesterday's brutal crash that took silver down to $73.71, today the metal is trading at $77.54, up nearly $5 an ounce. Gold ripped 3.5% alongside it, climbing back above $4,700. But the rally itself is not the real story today. The real story is what triggered it. The real story is what is happening inside the COMEX vault system underneath the price action. And the real story is the exact level silver is testing right now on its chart, a level that one of the most respected technical analysts in the world said would confirm a historic upside breakout. That level is $80. Silver is currently sitting less than $3 below it. The metal that was bleeding red just 24 hours ago is now charging directly into the trigger zone. And there are two specific data points that almost no one is connecting to today's move that completely change how you should be reading this market. I will walk you through both of them before this video is over. The first one explains why this rally is not just noise. The second one explains why the real breakout test may already be happening today, not at $80, but right now. Stay with me. Welcome to the Financial Factory. If you are not subscribed yet, do it now. This is exactly the kind of session where the next video matters. Now let us get into what actually happened, because the sequence of events over the last 48 hours tells you everything about whether this is a dead cat bounce or the beginning of the next major leg higher. Yesterday's crash had a single driver. Maritime tensions in the Strait of Hormuz sent oil prices surging to 4-year highs. The petrodollar mechanic activated immediately. Dollar strengthened. Inflation expectations spiked hard. Rate cut bets were wiped off the table. Capital rotated out of non-yielding assets in pure mechanical liquidation. Silver and gold got hit together. No discrimination, no nuance, just selling. Within 24 hours, that entire narrative flipped. Reports surfaced that Operation Epic Fury, the U.S. military campaign in the region, has been declared over. Project Freedom, which Trump announced over the weekend to escort vessels through the strait, is now reportedly paused. An evolving U.S.-Iran arrangement began circulating through financial media and diplomatic channels. The market did not wait for confirmation. Crude oil dropped 4.9% in a single session. The exact same petrodollar mechanic that crushed silver on the way down reversed direction on the way up. Dollar weakened. Inflation pressure eased. Rate cut expectations crept back into the pricing. And the capital that fled metals in a panic began returning just as fast as it left. Silver did not just recover, it outperformed. Gold climbed 3.5%, silver ripped over 6%. That gap is not a coincidence. It tells you silver is being treated as the high beta expression of this macro recovery. When safe haven flows return after a panic flush, silver tends to lead gold in the early phase because it carries more leverage to inflation expectations and industrial demand simultaneously. This is textbook. Yesterday was the petrodollar destruction phase. Today is the petrodollar reversal phase. Mirror image, opposite direction, same speed. Now let me show you what was happening inside the COMEX vault system while all of this was playing out on the surface, because this is the first signal I mentioned at the top. According to the latest depository report from CME Group, total registered silver inventory on the COMEX dropped by another 714,000 ounces overnight. That brings total registered silver, the metal that actually backs futures contracts and can be physically delivered, down to 79,593,000 ounces. That number just crossed a line that has not been crossed in years. Registered COMEX silver is now officially below 80 million ounces. Here is how that drain broke down. JP Morgan saw 640,000 ounces pulled from its eligible inventory. CNT Depository saw 599,000 ounces withdrawn. Loomis received 777,000 ounces, and then there is the entry that stands out from everything else in the report. StoneX Precious Metals moved 714,000 ounces from its registered category directly into its eligible category in a single overnight reclassification. This is not a deposit, this is not a withdrawal, this is silver being legally reclassified from deliverable to non-deliverable status while remaining physically inside the same vault. Once silver moves from registered to eligible, it can no longer be used to settle COMEX futures contracts. It vanishes from the deliverable pool without going anywhere. Why would StoneX make that move overnight, on a night when registered inventory was already sitting at multi-year lows? The CME does not require any public explanation for these reclassifications. But the timing does not happen in a vacuum. Registered inventory is what backs paper contracts. When registered silver shrinks while open interest holds steady, the coverage ratio deteriorates mechanically. Right now, that coverage ratio across the entire COMEX silver market is sitting in the low teens. That translates to roughly 1 ounce of registered silver for every 7 to 8 ounces of paper contracts outstanding. Exchange analysts have historically flagged anything below 15% as stress territory. We have been below that threshold for several consecutive months. This latest drain pushed it further in the wrong direction. If this kind of structural analysis is useful to you, hit the like button. It helps the Financial Factory reach more people who are actually paying attention to these markets. Now back to the data. Let me show you what veteran institutional analysts are saying about this exact setup, because the tone of the commentary coming out right now is noticeably different from anything published over the last 3 months. Robert Gototal, a senior precious metals trader with decades of institutional experience, just released commentary asking directly whether silver has entered the early stages of what he describes as a catch-up trade against gold. His framework is straightforward. Despite a persistent structural supply-demand deficit, silver has been lagging gold for months. Gold pushed aggressively to all-time highs while silver consolidated below its recent peaks. That kind of divergence between two metals with shared monetary fundamentals is historically unsustainable. When the gap stretches too far, silver tends to close it quickly and violently. Today's session fits that pattern precisely. Silver outperforming gold by nearly 2 to 1 in a single session is the early signature of a catch-up trade in motion, not the final chapter of one. Gotetla also noted that the intense physical pressure that drove silver flows from London to New York earlier this year has cooled somewhat. The immediate scramble has eased, but the underlying supply-demand deficit that created that scramble has not changed. The metal still needs to find its way somewhere, and institutional analysts are now openly modeling that this cooling period is exactly when silver begins repricing to close the gap with gold. When traders operating at this level start asking publicly whether the catch-up trade has begun, they are not guessing from the outside. They are watching institutional flows from the inside. That kind of question gets asked publicly right before the answer becomes visible to everyone else. Now, the second signal. Silver's chart structure since the January 2026 peak at $121 has been a clean, descending trend line, lower highs at every significant peak. The line connects the January top, the late February high, the early March high, and the recent April high. 4 distinct contact points along the same descending line over 4 months. Today, silver pushed directly into that trend line, within fractions of a dollar. This matters for one specific reason. A 4-month descending trend line does not give way on the first test without a fight. Most rallies that approach this kind of resistance get rejected, print a lower high, and hand the bears a fresh entry. But silver did not approach this line on weak volume or a modest bounce. It approached on a 6% intraday surge with aggressive volume behind it. That kind of energy at a key resistance level resolves in one of 2 ways: violent rejection or clean breakout. If silver fails here, the trend line holds. The bears reclaim the narrative. The pattern of lower highs extends. But if silver pushes through this line and holds above it on a weekly close, it triggers the technical confirmation that veteran analyst Michael Oliver identified earlier this week. Oliver pinpointed $80 on a weekly close as the level where the weekly momentum oscillator, the 10-week average oscillator, and the descending price trend line all converge and flip simultaneously from negative to positive. Silver hit that descending trend line today, less than $3 below the $80 trigger. The distance between current price and technical confirmation is the narrowest it has been in 3 months. The inflection point is not approaching, it is here. So what does the week ahead actually mean? Honestly, the next 5 trading sessions carry more weight for silver than any week since the January peak. If silver closes above $80 on a weekly basis, while registered inventory keeps draining and Eastern physical demand stays elevated, the structural conditions that historically front-run the most explosive phases of a precious metals bull market are all present simultaneously. If silver gets rejected at $80 and falls back, the consolidation extends. The lower highs pattern survives. The setup stays intact, but the timeline stretches. The risk-reward at this specific level is asymmetric. A failed breakout pushes silver back toward the $73 to $75 range. A confirmed breakout opens the door to Michael Oliver's published targets in the $300 to $500 range, derived from momentum methodology and historical commodity repricing cycles. No one can tell you with certainty which scenario plays out this week. But the current data configuration is one of the cleanest binary setups silver has produced since January. Here is what to watch over the next 5 trading days. Watch the Friday weekly close. Intraday moves above $80 mean nothing without a weekly close above that level. Friday afternoon is the only confirmation that counts. Watch the COMEX warehouse report each morning. If registered inventory continues falling below 79 million ounces, physical pressure builds regardless of what the paper market does on any given day. Watch the dollar index and crude oil. Soft oil and a weakening dollar extend the macro tailwind for metals. A sharp oil rebound reactivates the petrodollar headwind and silver faces it again. Watch silver mining equities. They tend to move ahead of spot during structural repricings. A breakout in mining stocks usually telegraphs the next spot silver leg before it shows up in the price. These 4 data points will tell you whether the $80 breakout is advancing, completing, or being delayed. Here is the broader picture from everything covered today. 3 days ago, silver investors were watching a brutal panic liquidation drain their portfolios. 2 days ago, the chart pointed to $80 as the level that would confirm the next major upside leg. Today, silver ripped over 6% on a geopolitical reversal. Registered COMEX inventory crossed below 80 million ounces for the first time in years, and senior institutional analysts began publicly asking whether the silver catch-up trade has started. Individually, each of those developments is significant. Together, they describe a market that moved from panic phase to early recovery phase inside a single trading session, with the next major confirmation level sitting just above current price. The investors who sold into yesterday's crash already missed today's 6% move. By the time the broader market catches up to what the data is already showing, the asymmetric entry window will have closed. Seeing it now means being positioned before everyone else catches on. Now I want to hear from you. Are you adding into this rally, holding your current position, or waiting for the $80 weekly close before making a move? Drop your answer in the comments. I read all of them. Subscribe to the Financial Factory and hit the bell so you do not miss the next update when this story develops further. Like the video on your way out. See you in the next one.